Hello, welcome back to Chapter 10, the discussion on liabilities. I thought I would spend some time talking about long-term liabilities, bonds specifically. The discussion begins on page 460 in our textbook. And I think when it comes to liabilities, bonds is probably the most challenging, most difficult in terms of the concepts and calculations that students need to become familiar with. So I thought I'd spend some time talking about bonds. But this discussion may span a couple, 2 or 3 lessons. We'll see how it goes. So, first of all, starting at page 460, bonds are a financial vehicle that government entities as well as large corporations take advantage of. Anytime these entities or organizations need to borrow more than a single lender can loan, then usually that's an indication of a situation where a bond issue may be in order. A bond, as defined in the textbook, is a financial instrument that outlines future payments to be made for a sum of money to be received now. And I think that's kind of a fancy definition for a loan. When you take out a loan, when you borrow money, you receive an amount now and you make the promise to repay that amount at some future date or over a period of time moving into the future. And your repayment would generally include interest as well as the amount borrowed, which would be referred to as the principal. Bonds are kind of a unique instrument. From the company's perspective, and let's just say that we are the company, so from our perspective, from the borrower's perspective, bonds represent a long-term liability. That's why we find them in this chapter on liabilities. From the bondholder's perspective, or the lender's perspective, or to put it another way, from the investor's perspective, a bond is a financial investment, very similar to stock. Of course, bonds are different from stock. We'll discuss stock in chapter 11, the next chapter that we cover. So again, when we issue bonds, we are borrowing money. That's our long-term debt. Those people who buy our bonds would generally be referred to as investors. They would be investing in the bonds that we are selling. But the essence of that transaction from the other side of the coin is that the investors are in effect lending us money. And one important note for the bondholder, bonds offer liquidity to the bondholder investor. In other words, a bondholder may buy $10,000 bonds now, which means they will be lending the company that amount of money. But a bond is a financial instrument that can be sold, actually can be bought and sold on the bond market. So there's an amount of liquidity. The liquidity feature is an important aspect of bonds. A person can buy a bond and sell it the next day if that person wanted to, or hold it to maturity. Probably one nice thing about investing in bonds is that bonds generally represent a stable and relatively low risk type of investment as compared to stocks. And the interest that bonds pay therefore can usually be relied upon to be a steady income flow for bondholders. I hope that helps. I hope that gives you a good idea of how bonds work. Of course, this discussion is from our textbook, so you can read the details in our text in chapter 10. Now, what I'd like to do is go over an example that runs through chapter 10. And actually this example I'm using is taken from Appendix C, which is in the back part of the textbook. But it's the same example that is being discussed in chapter 10 on bonds. Again, from page 460 moving forward. And so if you go to Appendix C, pages C10 and C11, the example given, and this is a bond pricing example, how the price of a bond issue is set. It's not an arbitrary calculation. There is a formula used which is based on the variables surrounding the bond issue that is applied, and the price of the bond is calculated based on a set formula. So let's see how it works. General Mills sold 100 4-year $1,000 bonds on January 1, 2010. So they are selling 100 $1,000 bonds, or $100,000 worth of bonds. Those bonds have a 4-year maturity, so they are repayable in 4 years. And sale date is January 1, 2010, and the bonds pay interest annually at 6%. So the stated rate of interest, the bond stated rate of interest is 6%. So what this example is doing here is pricing the bonds, assuming investors are willing to pay, and then they give 3 different rates of interest. And these are 3 independent examples of how bond pricing is calculated. So the first is 4%, the second is 6%, and the third is 8%. Now it's important to understand that when the example states, assuming investors are willing to pay each of these 3 rates, another way of saying that is that the market rate of interest could be 4%, or 6%, or 8%. Again, the stated rate of interest, the actual rate that the bonds will pay, is 6%. So you could have a situation where market, or what the average rate of all the other similar bond instruments out there in the market may be lower than our bond issue. It could be 4%, or that average market rate could be the same as our bond issue. It could be 6%, or that average market rate that investors are willing to pay could be higher than our bond issue stated rate. The market rate could be 8%, and depending on the market rate relative to or compared to our bond stated rate, the price of the bonds could be higher or lower, or could be exactly the same as the face value of our bond issue. In our example, the face value of our bond issue would be $100,000, or 100 bonds at $1,000 par value each. So what I want to do, to go through all of these examples would be, I think, quite overwhelming. It would be way too much work and a lot of time. So what I'm going to do is run through the example where the market rate is lower than our stated rate. The market rate is 4%. And again, this example is taken right from Appendix C, pages C10, C11. What I'm hoping to do here for you is to explain it in a way that hopefully will help you understand it. So to price these bonds, we need to be familiar with and be able to use the present value tables in Appendix C. And we need to use two different present value tables. Table C2, which is on page C15, and also table C4, which is on page C17. And the calculations would be done as follows. I think what I'll do is, before I get into the bond calculations, I'll end this lesson and start another lesson, so that each lesson is not too long. So I'll be right back with a follow-up lesson.